Hello everyone and welcome to the FCAI Insurance webinar, Understanding Your Insurance Program, What Contractors Need to Know to Save Time and Money. My name is Shannon Kelly and I am the Communications and Marketing Manager here at FCAI. I would like to introduce Brian Conan, who will be leading us today in our webinar. Brian is Vice President and co-owner of Conan Insurance for the last 20 years. Conan Insurance is a full-service independent agency that handles all lines of insurance coverage and has been around since 1963. Brian has extensive knowledge in business insurance for contractors and helps tailor policies to fit their businesses and avoid unnecessary exposures. Today, to submit your questions, attendees can do so by entering them in the bottom left-hand corner under the chat box. And with that, I will give you Brian Conan.
Thank you, Shannon. And thanks, everyone, for spending some time with me this morning discussing insurance for contractors and some issues around risk transfer in construction. As was mentioned, my name is Brian Conan with Conan Insurance, and our agency has been around now for 51 years, and I've been with the agency for 20 of those. The last dozen or so, I've spent a significant amount of time working with contractors and insurance programs. My goal today is to provide a 30,000-foot overview of various insurance coverages and the landmines around those coverages that are specific to contractors. In the last section, we'll review some of the issues and concerns around risk transfer in the contracting world. So with all that, let's get started. So I've broken this down into two sections, and one is really just kind of the insurance coverages that most contractors are going to run across, and not necessarily well into the weeds on the actual coverage, but more about specifics to landmines and issues to look for in your insurance program and to be aware of. So starting off, general liability coverage. So again, more about the landmines, but general liability coverage protects you from claims arising out of bodily injury or property damage that is alleged against you. So in essence, it's covering you against lawsuits, against your negligence. So some of the things that we see that can be problematic, and sometimes from contractors and just in general, is something as simple as listing the wrong name insureds, or maybe an inaccurate list, or not an extensive enough list. And when I say that, the named insured is the folks at the top of the policy. You know, they're the ones that are actually being provided coverage. And sometimes we'll see that an entity is either incorrectly listed, or maybe outdated, or maybe there's an additional entity that needs to be listed that has another piece of the operation that you're providing coverage for. So just being careful to make sure that the entity, if it went from a corporation to an LLC, that not only the change is made, but preferably if there's a commonality of ownership, that you actually list both entities. In the contracting world, if you had operated as ABC Painting Incorporated, and then for whatever reason changed your name to XYZ LLC, you want to have both those entities appear as named insureds, because you still want to pick up any kind of liability that might still come to you from activities of the previous operation. The statute of repose in Illinois is 10 years. So essentially what that means is for work that you do, you can get dragged into a lawsuit 10 years after it's completed. So those entities that have been around that, you know, possibly you've transitioned out of, still have liability that can come back to haunt you. So doing your best to keep that named insured list accurate and up to date is important. The other issue sometimes we see, and maybe not as specific to contractors, are things like if you own a building. Say, you know, if you have a contractor that has maybe a build out a commercial unit that they own, and the actual owner is not ABC Painting, but the owner is ABC Properties. A lot of business owners will buy a property and rent it to themselves, have a lease agreement with their actual contracting operation. And they will think to say, well, this other entity actually owns the unit I'm in, and they will leave that entity off the policy. Well, that's one of those things, making sure that you understand all the entities you've created and making sure they're insured someplace. A lot of times, if there's that commonality of ownership, they'll be all listed on the same policy, and the coverages provided for those entities will be on that same policy. But you can, and I have seen this at times, where that ABC landlord that was created, the LLC that is going to be the owner of the property, has its own separate policy, and that's perfectly fine. It tends to possibly be a little more expensive from a standpoint of coverage. You pick up a separate set of liability limits, so you have a little bit more coverage. But generally, it's more of a common practice to have all that coverage on one policy if there's commonality of ownership between the entities. So one of those things just to be aware of and keep an eye out for. The other thing we talk a lot about with contractors, and it comes up sometimes, especially when you start talking about working for other folks, either general contractors or owners, is named insured versus additional insured. And anyone you're working for is generally going to be asking to be additional insured. Named insured really is a top-line coverage. And basically, you're saying, I'm going to have direct liability for anything that happens on this policy if I put them down as a named insured. So I'll have a contractor call and say, hey, I need to add craft as a named insured. It's like, well, no, you don't want to add them as a named insured because we're not going to cover craft's operation as a named insured. They're going to be additional insured. Additional insured status gives them vicarious liability coverage for your operations. And vicarious means essentially that if you mess up, something happens, a lawsuit comes, in this day and age, they're going to sue everybody they can think of, and including whoever you're working for. And whoever you're working for, if they didn't cause the problem, they want to be able to pass this liability and this lawsuit down to the responsible party, which is generally going to be the contractor that caused the problem. And that's where they're asking for that additional insured status. They want to make sure that if I'm dragged into a lawsuit that you created, you're going to insure, you're going to defend and indemnify me from that claim. So one of those things just to be aware of more than anything else. The last section here, the last item on the general liability coverage that we're seeing a little bit more of in the contracting world is requests for subcontractors to have $2 million, $4 million limits as opposed to 1-2. It's been very common in the past through the years to have $1 million occurrence in a $2 million aggregate, which is $1 million available anytime one thing happens, but $2 million over the course of that policy year. So essentially, you can have that $1 million claim twice over the course of a policy year. Now they're asking more commonly for a $2 million $4, and I say more commonly. It's starting to pick up a little bit, and the issue there is that they want to have more limits available, excuse me, at that primary level, because the courts have said that primary level is going to be exhausted first before they start going into the umbrella. So one of those things to keep an eye out for in case it comes up in a contract relationship. And that's generally going to come up if you start working for larger general contractors. So moving on from general liability. Excuse me. Property coverage, I don't see a lot of issues regarding property coverage for contractors. Generally, it's going to be a building and contents, and usually not a significant issue for contractors. I will say sometimes when you do own a building, you want to make sure the building's insured for replacement cost or rebuilding cost as opposed to the market value. And that's a common issue with any kind of building these days, is that people keep thinking, well, my building is only worth X number of dollars. Well, when you go to insure it, the insurance companies are looking to what it would cost to rebuild that structure. Because you're not insuring it to get the actual market value. You're insuring it, and the insurance company's insuring it to rebuild it brand new if it would burn down. So just one of those things, if you do have a building, that's probably a conversation you probably already had with your agents regarding the valuation. And that's to my second point there. Always kind of think about the replacement cost rather than any kind of depreciated value that might be considered more market value. And the one nice provision, if you're talking about property coverage, you try to get as an agent and certainly as a client to look for is what's called agreed amount coverage. And essentially, that's when you get the agreed amount coverage, the insurance company and you are actually going to be agreeing that this value is correct and we're going to be fine with it, and it waives any kind of coinsurance penalty. Because there are penalties involved, and you're going to see coinsurance limits, and they'll usually be indicated at 100%, 90%, or 80%, and what those numbers are reflecting is the percentage of the replacement cost that you have to have the ability to insure it for. And you'll be penalized if you underinsure it below those percentages, whichever percentage that you and your agent select, and needs to be insured to at least that number. So if it's $1 million building and you have an 80% coinsurance, and I say $1 million rebuilding cost, and you have an 80% coinsurance provision, you can insure that to $800,000 or more. If you fall below $800,000, then if there's a loss, even a partial loss, you're going to have a penalty that comes into play because you underinsured the property. I have a question in my question box regarding charge to add additional insureds, and there is, and I can certainly talk to that a little later on in the risk transfer piece, but generally there's going to be a cost on an individual basis, and then at times, if it makes sense financially, you can get what's called a blanket additional insured statement, or a blanket additional insured endorsement, and that would be a little higher cost, but can help out if you have numerous additional insureds over the course of a policy year. So, those are the issues regarding property. Again, not usually too problematic for what I see in the contracting world. Inland marine coverage. Inland marine coverage is going to be property that's mobile in nature. So we just can't cover property coverage. Property coverage is usually be in a fixed location. You're going to have a building someplace. You're going to have contents within that building that stays within that building. That's going to be contents coverage. Now, once those items, tools, equipment start leaving that building, now we're talking about inland marine coverage. So it gives that you're going to inland marine coverage. In floaters, there's different terminologies, but essentially covering your tools and equipment as it's at the job site being transported in different places other than a set location. Some of the landmines, well, not so much landmines, but some of the issues regarding inland marine coverage, it generally is going to be a separation by most insurance companies saying, hey, give us the numbers, what you think your values are for small tools, and then give us your values on larger contractors' equipment. Those are kind of insurance terminology for it. And usually the delineation between those two is usually $1,000 or $1,500 in value. So anything smaller, below, say, $1,500, and it's insurance carrier specific, but usually around $1,000 or $1,500, you can put that in one bucket and say that bucket is $20,000. I've got $20,000 worth of small tools that I have, so we're going to insure those items over here. And then contractors' equipment generally is going to be listed separately. You can have a blanket amount for contractors' equipment, but they're normally going to want to have a serial number, some information regarding each item you have on that contractor's equipment list. I will say that from a rating standpoint, cost standpoint, generally the contractor's equipment items are going to be less expensive than the small tools. And the small tools tend to kind of disappear a little easier, stolen a little easier, so they tend to carry a little higher rate, whereas the contractor's equipment tends to be a little more substantial and tend to have a little lower rate from a standpoint of charges. And just mentioning there, just paying attention to you're going to have to list the contractor's equipment, and then also hang on to the documentation regarding especially the larger items. The one claim scenario I had not too long ago is that I had a contractor that was given it was a Bobcat, and essentially it was for a bad debt. So my contractor was working with another contractor. The other contractor owed him money, so instead of paying him off, he gave him a backhoe, and they called it even. Well, the problem was the backhoe was stolen, and the backhoe was listed on the policy, but when items are stolen, the insurance company generally likes to see some documentation that you actually own the item. Since he didn't buy the backhoe, he didn't have a purchase receipt. I think we ended up scrambling to find a manual to the backhoe or some just documentation that it was owned by him. So certainly not a bad idea to hang on to documentation, take pictures, manuals, anything you can have, just to make sure that if an item is stolen, you have some true documentation that it was owned by you. And certainly if it's damaged, it's going to be there still, so there's less of that concern. But it's really more from a theft standpoint. Most inland marine coverage is provided on what's called an ACV, or depreciated value basis. So unlike a lot of property coverage like buildings and contents, those items tend to be paid at replacement cost. So what it costs to replace those items new today, which generally is going to be more expensive than the depreciated amount. With tools, it tends to be more the depreciated amount. So if you have a backhoe, if you have different equipment pieces, it's going to be how old it was, what condition it was, and we're going to give you an amount to go get something in that same condition. Some carriers are offering the replacement cost coverage. Two things happen is you really have to insure the items to the replacement cost, and the rates tend to be a little more expensive, as you might imagine, because they're providing better coverage. So one of those things, again, to discuss with an agent to see if it's offered and see if it makes sense. Sometimes it's not a great additional cost, so it's something that you look for. But sometimes a lot of the equipment is available in the secondary market to be able to get that's not brand new, that most contractors are going to be fine with. So just something to be aware of. And the last item is just one of those landmines. As an agent, you stick in your mind situations that occur that especially significant in claims areas, in coverage areas. And this was one that I had a good client that called me up that was renting some equipment, and it was around $60,000. And they asked us, we provided a premium number that was going to be associated, and they decided that they didn't want to get it. And probably 2 weeks later, we get the call and asked about, was that ever put in place? And we confirmed that no, you decided not to get it. And long story short, they actually lost that item. The item was damaged. They were on the hook for it. So it's one of those things that if you rent equipment on a regular basis, it's good. It's not a very expensive item to add, but generally they're going to be looking to see what kind of maximum values you have rented over the course of the policy year. If it's done on a one-off basis, a lot of the rental places will provide some type of coverage for you on that short-term basis, but it is one of those things that if you're doing it often enough, it's a more affordable option to put it on your insurance program as opposed to continuing to pay the rental equipment facility operations. So just, again, something to think about and consider as you go through these decisions. From a standpoint of next lines, workers' compensation. And workers' compensation is certainly one of the larger areas that we talk about with the contractors, and it's a very large expense, generally one of the largest expenses for many contractors. So certainly spending some time in this area and paying attention to the details is very significant. The first thing there regarding managing your experience modification. So if you have experience modification, you're probably familiar with it. It's a number that's used to calculate your workers' compensation premium. And an insurance company is required to use that number in the calculation. And essentially, it's a report card. It's kind of telling you how you're doing against businesses with the same class codes. And class codes are 4-digit codes that are assigned to the type of work that you do in the contracting world. So if you're a C student, essentially it's a 1.0. The numbers go from 1.0 up and then down below. And if you're below 1, that's going to be what's called a credit modification or credit mod. And that's going to be a discount on your policy. So if it's a 0.92, you have an 8% discount. If you're 1.08, you have an 8% surcharge. So understanding that that's going to have a significant impact on what your insurance premium is going to be is something that you want to be able to manage it and spend some time paying attention to how it gets calculated. Now, I've done a webinar on this a few years back for FCAI, and it's I think probably a half an hour, 45 minutes long on its own. So certainly I don't want to get way into the weeds on that, but just a couple points to point out on the experience modification is just if you don't have any claims, you have the lowest mod you can get, which is a great thing. So congratulations. If you tend to have claims, or if you've had some claims in the past, it's a matter of just making sure that those claims are being attended to, being paid attention to, and there's feedback and follow-up with the injured employee. You know, the worst thing you can do is basically have somebody be out at work, never follow up with them. You know, the insurance company is maybe doing an okay job, but if they feel, you know, maybe slighted, if they don't feel like anyone cares for them, much more inclined to get an attorney involved, and that can certainly escalate the cost of that workers' compensation claim. From a standpoint of when that claim happens, the insurance company is going to put a reserve number down, thinking what they're going to pay on this claim, especially if it's any kind of significant size. And that reserve amount, no matter if it's eventually paid or closed at zero, is going to impact your mod as it stays on your loss history until it is resolved. So certainly looking at those claims, understanding if you have open reserves on previous claims, especially if you have large open reserves on previous claims, and trying to have your agent, work with your agent to be in touch with the insurance company, to be the squeaky wheel, to find out what's happening with that claim, to try to move that along. Because your claims history on the experience modification is not going to take the last year into account, the one you're just completing. So if your policy runs from January 1st to January 1st, the 2014 year we're in currently is not going to be reflected on your experience modification for 1/1/15. It's going to be the 3 years previous to that. So it's going to be 13, 12, and 11. So what happens is making sure that any of the older claims that are on your modification are being paid attention to. And the thing about that from a timing standpoint is that carriers are required to send the claim information to NCCI, National Council on Compensation Insurance, organization that oversees modification promulgation in Illinois. And they're required to send it down 6 months before the renewal of your policy. So 6 months before, so if you have that January 1st renewal, this information was sent to NCCI by your insurance company as of before July 1st. So probably a week or two before July 1st, this information is going down. So we want to get in talking to the adjuster before that information is sent down. So if there's an opportunity to change that reserve in our favor, that's addressed before, and probably maybe like a month before that date, just because it's going to take a little time to have the adjuster review the file and make a determination. And insurance companies can be notorious for over-reserving claims at times, so always good to just see, you know, if you understand the status of the employee and understand what's happening and they have a significant reserve, to try to get that engaged and possibly reduced before that information is sent to NCCI and locked in for your next year's experience modification. So one of those things to try to manage. And the biggest thing for contractors on managing that mod is keeping that modification below 1.0. And the reason for that is that you have in Illinois the contractor's credit available. It's the Illinois CCPAP. And this Illinois CCPAP stands for the Contracting Classification Premium Adjustment Program. And it really is set up to help union operations especially, so operations with higher wage employees be able to offset that high wage employee in the work comp world and help compete against those non-union shops that have lower wage employees. Because if you've got, you know, a lower wage employee out there working 40 hours and you have a union employee out there working 40 hours, and union employees making, you know, more money, the risk to those two employees are somewhat commensurate from the standpoint of getting injured. But as a union operation, you're paying more on the work comp cost because the wages are higher for the union employee. So years ago, they put into place this contractor's credit is the shorthand we use, but just making sure, one, that you're getting the contractor's credit, and two, that you're applying for it every year. It is a piece of paper that you have to complete, not a very complicated thing. And what they're getting to on the paperwork is essentially to figure out your hourly wage. And based on your hourly wage, they will give you a credit between 0 and 40%. And a lot of union shops that I insure are in that 35 to 40% range. So certainly, and the insurance companies have to give you the contractor's credit. That's not an option. So if you earn it, you get to have it reflected on your work comp policy, and that can save some significant dollars. And certainly, when you have some contractors you work with that have received the contractor's credit and have a few bumps in the road on the work comp plan, and then all of a sudden lose their contractor's credit, it can be a significant impact to their cost. So certainly, keeping your mod below 1, completing the form every year is a couple of the priorities there. You can complete that form, well, I believe it's into 6 months into your renewal policy, but after that, it's too late. So certainly they give you a little leeway to get that completed, and they'll apply it retroactively to your effective date. But there does come a time where they're not going to accept it for the policy year if you did not complete it. So most folks that get that are aware of it because it is a significant help on a cost standpoint. My last note here on workers' compensation, a little bit more specific on the paper and paper hanging and painting world. And again, a lot of folks probably are aware of this, but just to point it out, that is if you can maintain accurate records and be very specific about maintaining your employees' records and what they're doing, you're able to split out work done in the painting world versus the paper hanging. So if you do both operations, having a meticulous record-keeping process of indicating that Joe Smith was painting for 4 hours this morning, and then Joe Smith was doing paper hanging 4 hours this afternoon, is going to allow you to separate that payroll into the 2 separate classifications. And that can be very significant from a standpoint of cost. I think I just saw the 2015 rates for NCCI. So this is kind of a starting point for a lot of insurance companies of where their base rate is. It's $11 or so for the painting classification and $4 for the paper hanging. So certainly your ability to kind of track that and keep separate records is going to help you at audit time when an auditor comes in and say, let's see your payroll records, let's see your division of labor, and save you money if you're doing both types of operations. So something to keep an eye on there. Commercial auto, tends to, the biggest landmines we see, and this is, your own vehicles generally, is going to be titling of vehicles. A lot of contractors, especially smaller contractors, have a tendency to have, the vehicle title in Joe Jones' name, their own personal name, but then insure it on their corporate auto policy, commercial auto policy, and that can be problematic. Worst case scenario is in a claim situation and someone is seriously hurt, and they say, well, who owned the vehicle? It's like, well, Joe Jones did. Well, we have ABC Painting Incorporated that is the named insured on the policy. We don't have Joe Jones, so this vehicle, has no coverage essentially. So it's one of those things you want to make sure that there's some arrangements made, or the titling of the vehicle really should follow the actual policies are put in place. So if it's a personal auto policy named personally in your own name, have it on a personal auto policy separately. If it's a commercial vehicle, don't put it on a personal auto policy. It should be in a commercial auto policy. And the insurance carriers are usually saying, hey, titling is what they're looking at from that standpoint. And if it's a personal auto policy, a personally used vehicle, it can certainly be on a personal auto policy, and if it's commercially, you can rate that personal auto policy for business use, and the insurance company would be fine with that. I will get situations that occur where the client has all the vehicles titled correctly, but all the vehicles that they own in the commercial auto policy, and they have no personal auto policy because, possibly the wife's vehicle is titled in the company name and insured commercially. It's always a good idea to have some type of personal auto policy for just scenarios that can come up if you don't have one. Everything's titled commercially, and all you have is a commercial auto policy. You can accomplish that a couple different ways. One way, though, is have an endorsement being an add-on onto your commercial auto policy called Drive Other Car Coverage. And this extends coverage to other vehicles that may not otherwise be covered. And it tends to be those situations that are outside the box, but you borrow your neighbor's car to run an errand. The neighbor doesn't have auto insurance. They let it lapse. You get in a serious accident in their car. While their auto policy is supposed to be primary, they didn't have coverage, and now they're suing you. And if you don't have a personal auto policy to extend coverage to that situation, and you only have a commercial auto policy, that can cause some problems for you. Now, if you get the Drive Other Car Coverage, that's one of the ways to fix it. You can also get a named non-owner policy in the personal auto world to get that addressed as well. But one of those things, again, we see as a landmine in the insurance world and can trip people up in situations. Umbrella coverage. Umbrella coverage, the questions we get quite a bit on the umbrella side is how much do I need? And anyone working with general contractors, owners, get into agreements with higher tier parties are normally going to be dictated to what they're going to have. Normally it's going to be a requirement saying you have to have $1 million occurrence, $2 million aggregate general liability policy, and a $5 million umbrella. So, that generally drives a lot of the conversation. When you look at umbrella policies, these essentially are policies that are catastrophic in nature. They're higher limits of liability in case, you have a situation down below on one of your other liability policies, be it your auto liability, your general liability, employer's liability, that is more significant than the coverage you have at that level. It's a $2 million claim as opposed to $1 million, and now you have only $1 million occurrence. You're looking for get that additional layer, additional coverage. That's where the umbrella kicks in. And the conversations regarding how much, as far as the umbrella, apart from what kind of contractual relationships you get into, tend to be assets. Tend to be what kind of assets we have in the organization, and what the cost is to increase the umbrella policy. As you might imagine, the more assets we have, the more attractive we are from the standpoint of a lawsuit and the attorneys. So certainly the more assets you're going to want to have a little bit more serious conversation about maybe increasing that umbrella. And certainly the contractors that you enter these contracts into are going to tell you you're going to have a certain amount of coverage to begin with. But so certainly looking at what the additional cost of higher layers is, as you get higher and higher in the umbrella world, the costs tend to drop down a little bit because the likelihood of having that significant of a claim drops off as well. But there is a diminishing point of return. Should everyone have a $10 million umbrella? Probably not. But can you get one? You certainly can. So it's kind of a cost-benefit conversation we have with clients, saying here's the cost to go up to this level of umbrella. Is that additional cost worth the risk of not having it? So one of the areas to keep an eye on and think of. From a standpoint of just some other coverages to touch on briefly, builder's risk policy is a policy that's purchased by the owner or the general contractor, and it's covering the construction during the course of the building during the course of construction. So it's just basically a policy that takes care of its new construction. It's going to take care of construction until it's occupied, and if it's a remodeling job, it can cover the portion that's being remodeled. OCP policy is shorthand for owner and contractor's protective liability. You'll see these in contracts sometimes when you're a subcontractor and entering into it. It's not as prevalent anymore, but essentially it's a separate set of liability limits for a particular project. And it was more popular years ago, but it's been trumped these days by the risk transfer part we're going to talk about after this here shortly, regarding additional insured status and all the other requirements that GCs and owners are putting on the lower tier contractors. So you don't see that come into play so much anymore, but they are out there occasionally. OSIP, CSIPs, These are, for larger projects, you have owner-controlled insurance program and contractor-controlled insurance programs. And these are situations where you get into large projects that are possibly the Pepper constructions and the larger Turner constructions, and it's maybe a large project that's going to take years to complete. They will have a insurance program specific to the operation. So any subcontractor that comes on to that project is going to be insured by the OSIP or CSIPs program. So you get into one of those, really the biggest thing to be aware of is be aware that you're in a program, and normally you will be because there's plenty of paperwork to be completed to be in a program like that. But also understanding when you start, getting out of it, when you're completing it, that information, your payroll, your claims history, should flow on to your experience modification, and hopefully it's a positive impact from a standpoint of hopefully it's payroll on your experience mod is going to help be able to get you a lower mod. Of course, the lower mod is going to be able to be obtained if you don't have any claim experience. So, certainly if it's a situation you've got into a program like that, they usually last maybe your portion might last 3, 4, 5 months. When you come out, if you haven't any claims and you had some decent payroll on the job, just making sure that information does show up on your experience modification down the road, because that's going to help you. Now, certainly if you had horrible claim experience on that, certainly it would be a nice problem to have if it didn't show up in your experience modification. But that's one of those things to take a look at, be aware of, that if you get into one of those, just understand what you're getting into, because the coverage is provided, the claims paid by the OSIP carriers, and you'll be paying for that as a sub to the upstream party that you're doing the work for, and it'll be a carve-out on your program. So that's the other piece to be aware of, is that the audit comes, making sure that the auditor on your insurance program realize that you were in an OSIP or CSIP over the course of the last policy year, and generally you can identify how much payroll was involved with that, so you don't get charged twice. You get charged in the OSIP program and then get charged again on your own policy. So if you get into one of those, just make sure you have that conversation with your agent and understand what you're getting into there. Last thing here, becoming a little bit more common these days, is contractors' errors and omissions coverage. I'd say the last 2-3 years, we've seen this become a little bit more available in the marketplace. I've seen another carrier we work with roll this out. So it's out there, and what this is covering, it's not going to be bodily injury or property damage that you cause. It's going to be mistakes, errors and omissions. So if you were supposed to paint a building blue and you painted it red, that's not an insurance claim. The insurance companies don't want to be warranty work. They don't want to say warranty work that you did everything perfect. It's going to be a mistake you made, and if you had the errors and omissions coverage, that coverage would help take care of the cost of fixing that problem. So I bring that up just because you're seeing that become a little bit more relevant out in the marketplace. So that's kind of the insurance world from standpoint of the different coverage lines and different landmines around those different coverages that we see in the agency kind of day in, day out at times. From a standpoint of risk transfer, and I touched upon it a little bit in the previous section, but risk transfer is all about higher tier contractors or owners passing liability down to somebody they hire. And depending on who you're doing work for, you may have seen a little of this and you may have seen a lot. Certainly if you're working for large general contractors, this can be the bane of your existence, trying to meet contract requirements that are put into these, because all our subcontractors want to get the work, and sometimes they are a little overzealous and maybe don't look at the subcontract agreement they're about to sign. And after the subcontract agreement signed and they start to do the work, they start to realize that they didn't get all their T's crossed and I's dotted on the insurance side. And then they come talk to us. And those additions can cost money. And those additions, when they cost money, it maybe weren't worked into the actual bid that they provided. So to save yourself a lot of heartbreak and heartache and pain, making sure that we know about risk transfer, how it's working, and what we have to do from a subcontractor's perspective. Now, from the standpoint of what it accomplishes, is it's really trying to keep the liability at the level or at the employer or the company that created it. As you might imagine, as I think referred to before, is something happens at a job site, everyone gets sued. And now it's a matter of how do I extricate myself from this if I'm not responsible? And that's the general liability, the general contractor's perspective. Is they're saying, hey, Mr. Electrician just injured somebody, everyone's getting sued, I'm included in this. I'm ultimately responsible for the whole job site because I'm the general contractor, but I didn't, nothing I did as a general contractor was responsible for that injury. So I need to keep that, if I get a lawsuit, I need to be able to pass that back down. So that's essentially, the issues regarding risk transfer is that, anybody for a higher tier, and even if you're a subcontractor and you hire a sub yourself, you are going to be responsible for their activities, and you can get dragged into a lawsuit because of what those folks did. So as much as this risk transfer from subcontractors, from artisan contractors, are going to be generally going to be, dealing with the up-tier players as far as the owners and GCs, you also can get situations when you start hiring even, temporary one-person, small operations to come help out for maybe a specific activity or task, making sure that you get the certificates and the risk transfer in place from them, from the standpoint of a lot of things we're going to talk about here. And, again, that risk transfer defines responsibility payment shifted. Shifted down to the responsible party, the lower tier. I talk a lot about lower tier versus higher tier. This kind of illustrates a little bit. I have a couple slides here that kind of talks about it. But the owner basically wants to build a building and hires a general contractor. And I'm an owner. I don't, anybody that's higher tier has the hammer because they're paying the bills. So they can dictate terms. And it's incumbent upon you as a subcontractor to understand what terms you're getting into, what terms you can live with, and what terms you're going to have problems with. So, the general contractor is going to set that responsibility from the owner to maintain and have a good work site and be a safe work site. And they're going to hire a bunch of subcontractors to come in. And, again, they're going to have that subcontract agreement that's going to list out an insurance section about what you're required to have. It's going to have an indemnification clause. It's going to essentially say that you're going to hold me harmless of pretty much everything possible. Of course, again, I'm higher tier. I'm hiring you. I can dictate these terms in a lot of situations. And then as a subcontractor, you might have to hire that sub-tier subcontractor yourself. And being in that food chain, understanding that you now become responsible for them from a standpoint of their activities, their injuries, and their liability that they create. So that flow is illustrated here in the same, similar way from the standpoint of higher tier to lower tier. So certainly just understanding where you are in that food chain and what you're going to be required to do if you do get into situations where you're being hired by general contractors that have very, very elaborate subcontract agreements. So you get into the subcontract agreement, and you're at work, and now they're saying, okay, give us a certificate of insurance that shows all the things that were required in the subcontract agreement that you may or may not read when we gave you the job. And these are things that come to us, and when we're working with subs, that some can be problematic, some can be easy enough to add on, and just understanding kind of the differences there sometimes can be significant. The first thing, the specific additional insured form. Our industry has, years ago, had what's kind of the bane of a lot of different carriers is an endorsement, additional insured endorsement that was the CG 2010 1185 edition. So these endorsements have dates to them when they were actually created. So 1185, so November of 85, they had this CG 2010 is the nomenclature for the additional insured form. And the 1185 was a very broad additional insured form. And essentially gave the additional insured, so the up-tier party, somebody that you're agreeing to do work for and protect, it gave them very broad protection to the extent that he was giving sole negligent protections. So when I say sole negligence, the idea about additional insured is really vicarious liability. So vicarious liability means that if I do something wrong and for whatever reason you get dragged into a lawsuit because of it, I'll protect you. But you didn't do anything wrong. It was, I did the work, but I'm going to protect you because everyone's going to get sued. Well, court cases, through after 85, through the years, started giving the upstream party, that general contractor, coverage off of the subcontractor's policy for things that were the sole negligence of the additional insured. And that was never the intent. But, a lot of these things that change get played out because of interpretations through the courts and decisions of the courts. And, when a court decision comes down, you have the carriers kind of scrambling to kind of figure out a fix to try to accomplish, what the end game really was. I mean, the additional insurance endorsement back in 85 was not to give the coverage for sole negligence essentially of the general contractor. So if they did something wrong and it was completely their fault, they shouldn't be able to pass this lawsuit on to a subcontractor and have them pay it. But that's kind of what happened. And from then, there's been a number of different variations. I think the biggest thing on the forms is just understanding, looking at the subcontract agreement, seeing what forms, additional insured forms you're being required to provide, and then calling your agent and finding what kind of a cost associated with those. And even if a company will do it, we still see occasionally the CG 2010-1185 requested, and it is very few, if any, carriers out there willing to provide that specific form. So certainly something to pay attention to and to keep an eye on. In any type of additional insurance situation, you're essentially sharing your insurance limits. So, don't go around giving it out willy-nilly. I mean, you're generally these days going to have to do that if you get into a contract with somebody, and it does make sense. If I'm a general contractor, I'm an owner, I want that additional insured status. But just ensure or realize, as a subcontractor, you're essentially sharing your insurance limits with those upstream parties, with those folks that you've added as additional insured. I'll handle the waivers together just to move things along a little bit. But waiver subrogation, general liability, work comp, essentially when you waive the subrogation, you're saying to someone else that if you have some type of partial responsibility in this claim, we're not going to come back against you. We're going to say we're going to waive that subrogation ability. Subrogation essentially is if my insurance company pays a claim, they can subrogate or go back against the responsible party. Easiest example, everyday stuff, auto insurance. If I'm rear-ended by somebody and I have my insurance company take care of my bills and my repair costs of my vehicle, they can then subrogate against the person who's responsible, which is the person that was behind me who rear-ended me. So the same kind of thing applies when you waive subrogation in the work comp and general liability world. From a work comp standpoint, example of that would be if you have an employee that's on a job site and for whatever reason, maybe GC's employees in a pickup truck and he backs up and he injures your employee. Your work comp policy is going to be primary and going to be paying that injury to your employee. And then generally they would want to turn around and then go after the responsible party and say, well, general contractor, it was your employee that backed into ours. Well, when you waive the subrogation, you're basically saying, no, my insurance company is not going to go back against you again. Usually it's going to be GC, owner, somebody you're adding on, waiving subrogation to the upper tier party. And the same thing on the liability standpoint. If the liability claim comes and there's some partial involvement that the owner, general contractor, was responsible for, and your insurance company paid it, they're going to want to go after them for whatever contribution, help out because you were partially involved here. When you waive that subrogation on the general liability standpoint, you're stopping your insurance company from collecting that. And while that's difficult to get past if it's required, the downsides of that is obviously it's going to impact your loss history with your carrier. From the work comp standpoint, that work comp injury to your employee that got hit, if those medical bills are $60,000-$70,000, that $60,000 or $70,000 is going to hit your experience modification eventually, and then you're going to increase your experience mod, and it's going to increase your work comp cost. Whereas if your insurance company has the ability to go collect from the responsible party, that $60,000 claim would eventually maybe go down to zero and say, hey, you know what, we paid $60,000, but we got $60,000 from the responsible party, so really we had no work comp claim for you, so when you have your workers' compensation modification promulgated or created, it won't appear and it won't affect your mod. So one of those things you try not to give out willy-nilly, try to be prudent about it, but again, when somebody upstream has the authority or the requirement in their subcontract agreement, if you want to work for them, and that's something that makes sense, you'll have to abide by that. Having said that, the waiver of subrogation on the GL side, I'd say it's starting to get built into a lot of different policies, or maybe is a pretty nominal cost. The waiver of subrogation of the work comp is not, and is usually it's obtainable, but it can be a decent size expense. And generally the carriers are going to want to have some questions answered about what kind of projects you're going to get into and what the payrolls at that project are going to be. So certainly a more expensive item, and also one that's going to be a few more questions asked about whether or not they're going to provide that. Moving along here from the standpoint of a couple of things that are pretty easy that probably already built into your programs. Primary non-contributory wording and the per project aggregate wording. Primary non-contributory is basically just saying that your policy is going to pay before others, and you're not going to see contribution from other policies if a claim occurs that is your responsibility. So pretty standard and fairly regularly included by a lot of carriers. And the same with the per project aggregate. Per project aggregate is essentially saying that we're going to have your policies will have a general aggregate limit that applies separately to each project you get into. So it allows for some level of confidence from a general contractor that I have that coverage that I requested is going to be available for my project, and it didn't get eliminated, at a project across town that my subcontractor got into that had a significant claim, and now he has no coverage while he's showing me a certificate that has maybe $1.2 million. So indicating that that limit is available per project that client has. The 30 days notice of cancellation is one of those things that is difficult to get these days from the standpoint of a carrier being required to notify an up-tier party, general contractor owner, that your policies are canceled 30 days, are going to be canceling 30 days in the future. With the state laws indicating that they can cancel a policy for non-pay within, I believe it's 10 to 15 days, it becomes a difficult proposition for an insurance company to give 30 days of notice to a general contractor that your policies are canceling. Because your policies, they give you the 10, 15 days. Well, if they have to give 30 days notice, it's difficult to actually do that, because unless they have to extend the policies that you haven't paid for, and insurance companies are not really keen on doing that. So we've been able to accomplish that on one-off basis occasionally, especially for a client that has a good track record from a payment standpoint. So one of those things that had been more problematic a few years ago, but doesn't seem to be so challenging of late. Last few things here on certificates. We've seen this increase a little bit more regarding, and this isn't so much a certificate issue as it is a contract issue, that we've seen subcontract agreements require subcontractors carry their insurance program and to carry these additional insureds and these different issues on the certificates for 2 to 5 years past the actual completion of the project, which is one of those things from an agency standpoint is next to impossible to monitor. But the idea here is that the claims can occur after the project is completed, and they want you to continue to have coverage in place. So certainly statute of repose in Illinois is 10 years. So that means that an owner of a project can come back against a general contractor and all the subcontractors in a 10-year period if there's some type of issue that has caused property damage or bodily injury. So certainly there's an intent there to try to make sure that people that do the work aren't going to basically somehow not have coverage going forward. So one of those things we're seeing more and more in contracts. From a standpoint of the early question regarding cost, and there are additional costs for a lot of these things we just covered. Additional insureds, not completely too. It's usually, if you did it on a one-off basis, maybe $50, $75. But there is an ability, if you get into those relationships on a regular basis, to get a blanket. The blanket essentially says, we're going to cover you for how many additional insureds you have over the course of the year, not going to charge you on a one-off basis, and it's usually, say, maybe $250, $300 a year. So there's an economics there you have to kind of think through. Do I do this enough to get the blanket and spend the blanket money, or is this something that I just do it 2 or 3 times and it's going to make more sense to just buy them a la carte? And the same thing with the blanket waiver. They're basically saying if you get into a lot of contracts that have a waiver subrogation, and this is going to be more on the work comp side, it's going to be an issue, is that you can buy that on a blanket basis for the course of the whole year, policy year. And that is something that can be a little bit more pricey because the waiver subrogation of work comp is priced to begin with. So as you might imagine, the blanket waiver subrogation of the work comp is going to be that much more pricey. So just making sure that you actually pay attention to these things because they all can add cost. And the biggest thing is making sure you pay attention before you enter into a subcontractor agreement. So I am looking at a question in my box. The waiver subrogations can be required on an individual basis or job to the GC, owner, architect, and or engineering company. So actually, I'm not sure if that's really a question, it's more of a statement, but I do see that as basically kind of what I just indicated, that these can be done on a blanket basis. And if you're doing them enough, it certainly can save some money by getting a blanket waiver and getting the blanket additional insured endorsements put into place. And one of the last slides here, the biggest thing is just understanding what you're getting into from the standpoint of the contract that we just kind of touched upon. Sometimes the contracts are going to have an indemnification agreement that's going to be broader than the insurance requirements. So this is just more of a heads up. From the standpoint, you might be perfectly fine with the insurance requirements, but there's going to be maybe an indemnification agreement. There's going to be a section in that subcontractor agreement that's going to say, to the full extent permitted by law, the subcontractor shall indemnify, defend, hold harmless, yada, yada, yada. Essentially, again, they're upstream, so they have the ability to pass down as much liability as they want to, and certainly their attorneys are trying to pass everything they can off to the subcontractors that are doing work for them. So understanding how broad that indemnification agreement can be might give you pause and might want to have that conversation again with an agent reviewing what kind of contracts you're getting into. And this goes back to, have good legal counsel. Always good to have somebody in the legal world that deals specifically with contractors if you're really getting into subcontract agreements on a regular basis. And the same thing with the insurance. Make sure you review the contract before you get into the contract or before you enter it and you sign into the contract so that you understand what the cost is going to be. Because I can't tell you how many times we have a subcontractor that is having his last payment that is due to him, and it's, say, $2,000, but now the upstream party, the general contractor, is saying you didn't do this, this, and this, and those things are going to be another $1,000 to him, or another $1,500 to him. Or worst case, the carrier says we won't do them, and now you have a contractor that could possibly not be able to get paid that last installment. So just being careful to that. So with that, I am pushing my luck here with a couple minutes left. I apologize about that, but we'll certainly open it up to any questions that may come up.
Yes, thank you, Brian, for that. Yes, again, as a reminder, if you do have any questions, you feel free to enter them in the bottom left-hand corner under the chat icon. And then, Brian, I did want to pose a question to you. OSHA has proposed a new rule on airborne respirable silica exposure threshold on the job site from 250 to 25 micrograms per cubic meter of air. What effect will this have on insurance?
From an insurance standpoint, I would think that obviously, if you can reduce any kind of particles in the air and reduce the likelihood of employees getting injured and having those kind of illnesses, that's going to be a good thing. So that'll be helpful. I'm sure the contractors, it's going to be an expensive proposition to keep the levels at that point. So there's going to be some problems in that regards, I'm sure, in cost for the contractors. From an insurance standpoint, though, it would be probably a beneficial thing from a standpoint of the likelihood of future disease, illnesses. I could see though some liability coming up from a standpoint of workplace liability if they weren't maintained to that level and people got injured and maybe looking for recovery of more than just the work comp benefits. Then it gets into negligence at a job site, not having a safe job site, and you could certainly see further litigation in that area if that were to happen.
All right. Great. Well, we've reached the end of the hour. Just as a reminder, this webinar is being recorded and will be available on our website within the next 24 hours. So if you missed it or if you wanted to listen to something else again, it will be available on our website under Education. So I want to thank, again, Brian Conan for presenting on this topic. And with that, I think we're good.
Wonderful. Well, thank you. Appreciate it. Everybody have a great Christmas.
All right.